This video is the third clip from an interview I did with Tom Reed, who's the China Oil VP for Argus Media. And he's an expert in Chinese oil demand, but particularly the petrochemical and refining sectors. Now, in it, we talk about the uncertainty of Chinese demand, peak oil demand coming, what happens when demand begins to decline. But we talked about it mostly in the short to medium term, not the long term. And it occurred to me while I was looking over the interview that there's a graphic that I used in an August 9th video that's very germane here. So here it is. And it is based on modeling from Chinese sources. So the first one is Sinopec, which is the big state-owned refiner. The second is China National Petroleum Corporation, also state-owned. And then Peking University, which has an energy analysis unit attached to it. And you see the peak years there. 2027, 2023, 2020, 2030, they don't all agree, but it looks like from the data we're getting now is that in fact Chinese oil demand may peak this year, may have already peaked. But if it isn't peaked this year, it's coming very, very soon. But here's the thing. Look at the 2050 levels that they're modeling. Chinese oil demand right now is about 17.5 million barrels per day. Sinopec, 7.5 million barrels a day in 2050. China National Petroleum Corp, 6.25 million. Peking University, 5.25 million. The point here is that at the very minimum, they're modeling a loss of 10 million barrels a day, and it could be even higher heading out. Now, why that's significant is because as petroleum is not going to grow, maybe a couple million barrels a day by 2050, if transport fuel demand falls, road transport fuel demand falls that quickly, then the question is, what about the producers who are already servicing Chinese demand? That would be a lot of it comes from Saudi Arabia, some of it from Iraq, even some of it from Mexico and Venezuela. The Middle East producers in particular are very, very low cost production. And their transportation costs to China are $2 a barrel by marine transport. Whereas Canada is about 18 bucks on Trans Mountain expansion. So if they decide that they want to take market share from Canada because Chinese demand is dropping, they could do it. So that's some additional longer term context that's really important. And I hope you enjoy Tom's interview. It sounds to me like the demand from the petrochemical sector will probably grow through the rest of this decade and into the next decade. But beyond maybe even 2030, there are major uncertainties facing those producers. Is that fair to say?
I think so. Although I would make the point that on that sort of time frame, everything becomes radically uncertain.
Yes, fair enough. I mean, if
Yeah.
the IEA is correct and we're going to have peak oil demand, global peak oil demand in 2029, then that kind of throws a wrench into a lot of forecasting and modeling, doesn't it?
Well, quite. And we're recording this on the 15th. Donald Trump is meeting Vladimir Putin in Alaska. The implications of that are going to have, far-reaching implications for oil markets, and we have no idea what's going to happen.
Other energy economists that I've talked to about what happens as we approach peak oil demand have mentioned that volatility will be increasingly a characteristic of oil markets going forward. Would you agree with that?
We do seem to have entered a period of fairly radical policy-driven uncertainty, which I think makes it very hard for energy economists or corporate planners to make decisions, certainly in the short term. Over the long term, you might hope that some more stability might return to the market. Whether it will, I think we live in hope.
I mean, you could, given the fact that we're approaching peak oil demand, you could make an argument that as geopolitical uncertainty diminishes over time, that demand would create demand loss, demand destruction might create more uncertainty, leading to volatility.
Yes, I guess that is perfectly possible. I mean, the outlook in the short term is highly uncertain, and in the long term, it's highly unpredictable. And yeah, that is going to be a real headache for oil companies looking to build long cycle projects. I think, in terms of Chinese demand, I think as long as Canadian crude remains competitive, China will buy it. Whether Canadian crude remains competitive, if the investment costs involved in this new pipeline push up their break even to a level that they can no longer perhaps compete in quite the same way that they are doing now with those Saudi barrels, with the Iraqi barrels, then that would quite possibly give them pause for thought.